And now it's time for Talking Trade with Sandy Siegel and Ken Wasylik, sponsored by the Dairy Farmers of Wisconsin, Carroll University, and Michael Best Strategies.
Welcome to another session of Talking Trade. I'm Ken Wasylik, Managing Director of E.M. Wasylik & Associates, an international business consulting company. Well, today we have a special guest. We have Alex Wolf, the Global Head of Macro and Fixed Income Strategies at JP Morgan Private Bank, based in New York. Alex leads a team that's responsible for shaping the private bank's global macroeconomic views, as well as recommendations to their clients on fixed income and currency investment strategies. But I think more importantly, and I think this is really great that you're on the show here, Alex, is that before that, you were the head of Asian investment strategy, where you oversaw the research and analysis of the Asian Pacific region. So Alex, thank you for joining us on Talking Trade.
Sure, thanks for having me.
Great, great. Well, let's start with just where we are today in 2026. It seems like international trade has been very volatile. There's fluctuating trade policies every month, every week. There's a change in our tariffs, in our geopolitical looks, supply chain rewiring. We have two major wars, one in Europe and now one in the Middle East. And then, of course, all the associated geopolitical tensions with China and other countries, Europe as well. And it all seems like it's every week, every month, the business community is hit with another disruption, and it all becomes almost like a new normal or a structural feature. So can you just give us an overview of where we are today for international trade and from an investment perspective?
Sure. That is a good place to start. It definitely does seem like we're in a new normal where we're seeing pretty persistent shocks. And just to catch up over the last couple of years, the events that you mentioned, of course, the Russian invasion of Ukraine, that was a supply chain shock. And then Liberation Day last year, what we saw with tariffs, the largest increase in tariffs in about 100 years, but then also the Supreme Court ruling many of them illegal. And now with the war in the Middle East being another significant historic shock to commodities and broader supply chains. I think the summation of all of that has been one of a couple of years where we've seen more stress on global supply chains than we have in a very long time. And so on the negative side, you almost have a persistent state of uncertainty, and almost even, you could even say trade policy almost looks like the goal of it is to be uncertain and opaque and to keep companies guessing, because certainly the shifts in tariffs have been very volatile. On the other hand, though, we have seen the fact that global trade, if you're just looking at the data and the statistics, global trade has held up. We're still seeing pretty healthy trade in goods, healthy trade in services, and judging by all measurements of export growth and import growth, et cetera, it has held up better than initially expected. Of course, if you go back to April last year, and you had a lot of projections and forecasts showing a cratering in global trade, certainly that hasn't come true. We're seeing still pretty robust demand. So companies have been able to adapt, supply chains have been able to adapt. And so I think the resilience that we're seeing in terms of the flow of goods and even the flow of capital has been a silver lining or an interesting surprise relative to all of these shocks that we've seen in the last couple of years.
Yeah, well, we had a program about a year ago thinking, Liberation Day, and we're all looking at, hey, prices are going to go up, right? Inflation's going to go up. We have these tariffs, and we had a program on Talking Trade about a month ago saying it really didn't happen as much as we expected. So can you do a comparison of, hey, what we expected and where we are?
Sure. That is a good question. And I would say from our view at JP Morgan, we didn't really expect inflation to be that much of a problem, at least in our view, relative to where consensus was. But I would say where consensus was, they were expecting a significant inflationary shock from tariffs. What we actually then saw, though, was that tariffs can be absorbed at different points on the supply chain. It can be absorbed by the exporter who can lower their prices. It can be absorbed by the importing company in terms of their margins, or it can be absorbed by the consumer in terms of a direct pass-through of that price increase to the consumer. If we go back to 2017, 2018, we saw about 90% of the tariffs, even higher, close to 100, were directly passed on to the consumer. This time around, we saw it shared along different points. We did see exporters, whether it was out of Japan or out of Korea or out of China, cutting prices to North America, essentially to the US, to absorb some of that cost. We saw some of it being absorbed in margins as well, and then we saw some of it being passed on to the consumer. So you saw more of it being absorbed at different points of that trade supply chain, meaning that the overall upside to inflation was less than initially expected. The other thing is that we did see goods inflation, but goods is just one component of the basket. Mm-hmm. And the rest of the basket, the CPI basket, which is mostly services, were still pretty soft. And as a final point, and I would say this is one thing that we had been anchoring on, is that if you look at the history of tariffs, historically, tariffs are not inflationary as people expected them to be. Usually it reduces demand in a way that it actually is deflationary. So you tend to not see an outright inflationary impact because it's essentially a tax hike. It's a tax increase. It reduces disposable income and reduces the spending on discretionary goods, which actually can soften demand and put some downward pressure on prices. So I think the initial understanding of the tariff impact on inflation was somewhat clouded based on what we saw throughout history and what the actual experience would look like.
Yeah, I would say our clients did the same. They passed on some of the increase, probably as much as you possibly could, because it's a negotiation, especially if you're dealing with the major retailers. You know, whether it's the Walmarts, the Costco's, the Targets. I mean, these are large volume, long-term contracts, and it's very difficult to just increase the prices, right? And so, and you're right. All our clients went back to their Asian suppliers and say, okay, I know we're not going to buy as much, but, and then there's all this negotiation. But I also saw that, productivity is up as well, whether it's AI or some other, and that absorbs a lot of costs as well.
Yes, very good point.
Yeah, so it's good. So, but at the end of the day, our relationship with China seems to be hot, cold, and now Trump just came back from China, and now it's warm again. But the China trade surplus is still huge, right? $1.2 trillion US. What's the impact on that of the global markets here in the US as well?
Yeah, it is. I think one of the more interesting, impactful trends that we're seeing in terms of the global economy, but it's maybe getting a little bit less attention here in the US. So we've seen the US increase tariffs on China pretty substantially. Both you can go back to 2017, 2018, but then even now, the most recent round of tariffs, that has reduced how much we in the US import from China. So our imports from China are down about 20, 25%. So, and our trade deficit with China is lower because we're importing less. But to the point that you just made, China's trade surplus, overall trade surplus, has continued to balloon to the point that it is now $1.2 trillion for the full year of last year, meaning that they're sending less to the US because the US is buying less, but they're flooding the rest of the world with goods. So they are finding other markets and in many ways increasing export growth to the whole rest of the world. Now that is increasing pressure on the rest of the world that is seeing a flood of cheap Chinese goods, and they're seeing their trade deficits with China expand. So the tariffs that we put in place have meant less coming to the US, but it has not impacted China's overall trade at all. And you could also say too, there is another possibility that we are in the US are in fact importing as much from China as we used to, but it's now rerouted through another country, through Mexico or through Vietnam. And so it's not showing up as being from China, but still is. So that of course is a possibility, but this is a very interesting global trend. Like Europe right now is under a lot of pressure. They're seeing a number of their industries facing increased stress of imports from China that they can't compete. Even emerging markets, Indonesia, other countries that have a large manufacturing sector, they have a large exporting sector. They are also now under pressure from a flood of Chinese imports. And so China's exporting engine is as large and as powerful and as efficient as it ever was. And the fact that US put tariffs in place has just actually increased the pressure on the rest of the world.
Yeah, no doubt about it. I mean, I see it every time I talk to our European counterparts. They're always saying, "Hey, the Chinese vehicles
Yeah,
and
yeah,
alike are taking over the European marketplace." And I said, "Well, eventually you might be like the United States and putting tariffs on
yeah,
Chinese goods." And yeah, it kind of goes back to we had a conversation I had at dinner, and I says, well, at the end of the day, if you lose one market, that's business 101. You go find other markets that you're going to sell your products, and we do that, and that's what we do as business people, and that's what the Chinese
exactly.
are doing as well.
Yeah, yeah.
Keeping on to China, I've heard this term called China Shock 2.0. Can you give us an overview of what that means?
Yeah. So why it's called 2.0 versus 1.0. So China joined the WTO, the World Trade Organization, in the early
Right,
2000s.
right.
When they joined the World Trade Organization, that opened up global markets more or less to Chinese goods. And because China is such an efficient producer back then of, you could say, lower value added manufactured goods across a wide range of whether it's apparel or textiles or even furniture, we saw the global economy, particularly the US, saw a surge of imports from China, Chinese exports to the world. And in the US, and there's some wonderful papers written about this from professors at MIT and Harvard that looked at the impact, this surge of imports from China and what that did to domestic industries in the US. And we saw that whether it was in the Midwest, in places like Wisconsin, or it was in North Carolina, where they have a furniture manufacturing industry, that this flood of imports from China really reduced employment and jobs, and in some ways just crushed domestic industries, especially domestic manufacturing industries, because they could not compete with the price. That was the China Shock 1.0. But there was always this view that China was kind of the lower value added, that they manufacture in a labor intensive way, but we in the West, we innovate and we stay ahead. What's happened is now China has just moved up the value chain. They're as innovative as one can be, and they are now manufacturing exactly what you said, EVs, but cars that are at the cutting edge and as good as any car you can buy really anywhere, but at a lower price point. They are also beginning to manufacture their own domestic semiconductors, and you kind of get the point. Very higher value added goods, and now we are seeing them ramp up production and compete on cost in a way that the rest of the world can't compete. So that is the China Shock 2.0, as they went from the lower value added, more labor intensive, to more the higher value added, high tech goods. And we're seeing EVs is a great example, but not just EVs, cars, where China, if you go back just pre-COVID in 2019, even 2020, China was not much of an auto exporter. They were not really a player in that space. You had Japan, Korea, Germany, US. In the span of 5 years, China went from exporting about 1 million units to now about 8 million units. It is the most dramatic increase in exports that they are now the world's largest car exporter by far. They've surpassed Korea, Japan, Germany, and they are now at the top. And so that very rapid ascent in higher value added goods is considered the China Shock 2.0, where places like Germany, even the US, Japan, are seeing competition in sectors that they deemed to have a comparative advantage in, or sectors where they had an advantage from technology or cost. China is now competing in that space, and they're seeing a flood of cheaper imports and finding it very hard to compete.
Yeah, yeah. Well, my first visit to China was 1994, and you could see the revolution happening, on that lower end. And of course, and then as I progressed, over the last 30 years, you're right. They're just moving up the value chain, just like every other developing country, and being the number two largest economy in the world right now. So, okay, so
Yeah.
those are a lot of the concerns. But every time there's volatility, there's always winners. There's always a flip side of, there's positive movements. So can you just identify some of those positive movements with all this volatility and disruption that's going on?
Yeah, so as we've talked about trade and supply chain disruptions, and of course we didn't really go into depth around Iran and the impact that's having on the oil price. You have all of that going on, causing it, like you said, volatility and concern. On the other hand, you have the other major trend of AI and particularly investment in data centers, investment in AI capabilities.
Right.
That is, in many ways, a historic tailwind for the economy and for markets. And in many ways, it's going to likely be a historic investment cycle. And that is a completely separate driver of the economy, even the global economy. When I say global economy, of course, it is having a big impact on the US. We are seeing hundreds of billions of dollars spent on data centers and AI capabilities. Of course, seeing now the emergence of new AI companies, and they're beginning to list or file for listings. And so the impact on the economy and the impact on markets is quite significant. We still see that as a continued opportunity, but it is global in the respect that the chips that are being installed in data centers are largely manufactured in Korea and Taiwan. And so you've seen also tremendous growth in exports and overall GDP growth in East Asia. Taiwan's a great example where it is a relatively developed economy, high per capita income. It tends to grow on average, say, 2 to 3%. Last year, it grew about 8%. In the last quarter of last year, in real terms, it grew about 13%. And that's just because of this insatiable demand for memory chips and semiconductors. And so that is really an interesting tailwind that we think will continue to play out as we're still in the relative early stages of AI adoption. So I think it's important to kind of keep your eye both on, yes, there are a lot of supply chain risks, but there are pretty significant opportunities from this structural tailwind of the AI build out and then eventually increase in AI adoption and the impact that has on growth and productivity.
Yeah, we see it in our own company. We're using the simplistic AI tools, and our productivity has increased, dramatically once you master how to use the tools. So we're almost out of time, and I'm going to ask you one question since you're the head of fixed income strategy and economics. So if I was an individual investor, what should I be investing in 2026?
Sure. So assuming that you have a balanced asset allocation or balanced portfolio, you're still going to want to have exposure to equities, and we would favor the US. Exactly those themes I talked about. We would favor the US and emerging markets. The US just has more tech in the economy and in the index than in Europe or Japan, but also emerging markets to get some of that Korea and Taiwan and China exposure. So still want an allocation to equities and can be overweight equities. Fixed income can help protect on the downside, help protect a lot around those risks that we talked about. And there we favor short-dated bonds. Recently, there have been a lot of scares around inflation and the impact of oil on inflation. Market has kind of repriced what they expect the Fed to do. So it's pushed yields up to a more attractive level. So right now it makes a lot of sense to have short-dated fixed income. And then also, if you have concerns around US debt or concerns around the 10-year, then you're not as exposed to that. You're more at the front end. But then also because of potential for supply chain disruptions, but also potential for commodity prices to go higher on the back of Iran or back of just insatiable demand for resources around AI, want some exposure to things that can protect around inflation. And that can be real assets, exposure to infrastructure, exposure to real estate, exposure to commodities such as gold. Have some of that in your portfolio as well to kind of protect a little bit around the inflation side. So think about it still from a balanced perspective, but the different allocations that you want. So exposure to the AI theme, fixed income for more certainty of income and take advantage of attractive yields, and some either alternatives or real assets that can help protect on the inflationary risks.
Okay, well, thanks for that advice.
Sure.
So, okay, I'm going to be calling out my JP Morgan wealth manager right as we speak.
Right.
So, Alex, it was great to have you on the show, and thank you for joining us, and hopefully we can have you on the show sometime in the future. So
thanks for having me. Enjoy this.
And I'm Ken Wasylik, Managing Director, and thanks for joining us on Talking Trade.
You've been listening to Talking Trade with Sandy Siegel and Ken Wasylik, sponsored by the Dairy Farmers of Wisconsin, Carroll University, and Michael Best Strategies.